If you're a regular person like Sarah, working hard, earning decent money, but your savings feel stuck and your future still looks average, listen closely. In March 2009, the S&P 500 bottomed at 676 points. The world was falling apart. Retirement accounts were cut in half. People were terrified. Sarah, a normal teacher in her 30s, had $50,000 saved for a house down payment. Her friends said wait. Her family said it's too risky. She ignored them and put it all into a simple S&P 500 index fund. Today, that $50,000 is worth about $590,000. She didn't pick hot stocks. She didn't time the bottom perfectly. She just acted when most people froze. From 676 to over 7,000 points by 2026, that's a 900% plus rise. Regular people who kept investing through the fear became millionaires. Most didn't. Most sold low, panicked, and stayed average. Now here's the uncomfortable part. We're living through something even bigger. Not a crash, but a $124 trillion wealth transfer over the next 20 years. The largest in history. Trillions moving from boomers to regular people like you. 379,000 new millionaires were created in 2024 alone. Over 1,000 every day. If you're not positioned right now, you'll miss it, just like most missed 2009. But if you follow 5 simple rules starting today, joining the new millionaires and leaving average behind becomes extremely difficult to avoid, even if you're starting from regular. Sarah is 38, a regular marketing coordinator earning $85,000 after taxes, about $5,200 landing in her account each month. She contributes 8% to her 401k with a match and thinks she's doing okay. Her retirement total sits at $80,000. Fixed costs feel normal. Rent $1,950 for a decent 2-bedroom, car payment $520. She upgraded last year. Insurance $220. Utilities and phone $280. Groceries $650. That's over $3,600 gone before she even considers eating out or small trips. Most months she ends with $1,000 to $1,500 buffer. But one unexpected $900 repair or dental bill drops it near zero, and the stress hits. I should have more by now. She scrolls social media, sees friends buying homes or traveling, and promises herself she'll save more soon. When a raise comes, it quietly funds a nicer place or better car. It feels like progress. Marcus is the same age, similar $82,000 income, roughly $5,000 take-home. His retirement savings? $220,000. Fixed costs? Rent $1,450. He stayed put after raises. Insurance $180 on a paid-off car. Utilities $240. Total around $1,870. He auto-transfers $1,000 to investments on payday. The rest covers life calmly. When his car needed tires last year, he paid cash without blinking. He joins friends for dinners but skips extras. He doesn't feel deprived, just intentional. Both live in the same city, work hard, face similar bills and pressures. Sarah feels okay because she pays on time and saves a little. Marcus feels calm because he built structure early. The difference isn't huge salaries or genius moves. It's boundaries that let compounding start quietly instead of waiting for someday. Sarah drifts month to month on autopilot. Marcus builds steadily. Over time, that small gap widens into a massive one, just like it did for regular people who invested through 2009 instead of waiting for safety. The uncomfortable truth most regular people never face until it's too late. A massive $124 trillion wealth transfer is already underway, the largest in human history, and the vast majority will miss most of it. According to Cerulli Associates' 2025 research, roughly $124 trillion in assets will change hands between now and 2048, about $105 trillion going to heirs and $18 trillion to charity. That's more than 5 times the entire annual economic output of every country on Earth combined. Over the next 20 to 25 years, trillions will move from boomers to younger generations, fueling economic expansion, asset price support, and new opportunities. But here's the brutal part. Most of that wealth won't go to people who are already rich or have insider access. It will go to regular people who are positioned correctly, and most aren't. In 2024 alone, the US added 379,000 new millionaires, more than 1,000 every single day. Since 2010, America created over 15 million new millionaire households. That's the entire population of New York City becoming millionaires in 14 years. Who benefited most from the last big shift after 2009? Not Wall Street traders, not hedge funds, regular people, teachers, nurses, accountants, who kept investing in broad index funds while everyone else panicked. The S&P 500 went from 676 points in March 2009 to over 7,000 by 2026, a 900% plus rise. $100 invested at the bottom became roughly $1,000. Those who stayed in the market quietly built extraordinary wealth. Sarah is on the path to missing this one. Her $80,000 saved at 38 is modest, but without structure, lifestyle creep will eat every raise, and she'll end up in the average retirement bucket, stressed, trading off basics at 65. Marcus, with his rules in place, is already positioned, compounding quietly, ready to capture whatever comes from the transfer. New jobs, asset appreciation, inheritance flows. The math is unforgiving. If you invest $500 per month starting now at 7% over 20 years, that's approximately $250,000 from contributions alone. Miss the window, keep drifting, and you get average $200,000 median retirement, 50% lifestyle drop, constant anxiety. The transfer is happening whether you're ready or not. Most people will watch from the sidelines. The ones who win are the ones who act with simple rules before the opportunity fades. This isn't luck, it's positioning. And right now, you're still early enough to change sides. Take a breath. You're not too late. You're not unlucky. You're not missing the $124 trillion transfer because you're regular. You're missing it because you haven't positioned yourself yet. Sarah isn't doomed. She works hard, pays bills on time, avoids big debt, and contributes to her 401k even if it's only 8%. She feels that quiet guilt when her balance barely moves, and that guilt means she cares. Most people who stay average never feel it. They drift until the opportunity passes. You're noticing the discomfort now because you already know average isn't the future you want. That's not weakness. That's the exact awareness that separated the people who bought in 2009 from those who sold low and stayed stuck. The relief is this. The transfer isn't only for the ultra-rich or the lucky. It's going to regular people who simply position correctly. The majority of new millionaires since 2010 weren't executives or entrepreneurs. They were everyday workers, teachers, nurses, accountants, who kept investing in broad index funds through fear. They didn't need genius timing. They just needed structure and patience. Sarah doesn't have to become someone else. Marcus didn't. His $220,000 at 38 isn't luck. It's boundaries that let every dollar work while the transfer unfolds. Sarah can still get there. You're in the same spot. The window is open. The rules ahead are simple, boring, and repeatable. Exactly what regular people used after 2009 to become millionaires. You don't need to be special. You just need to start positioning now. Let's install those rules before the moment closes. Rule 1. Maximize tax-advantaged accounts. Shelter every dollar you can before the $124 trillion transfer accelerates growth. For 2026, 401k limit $23,500 plus $7,500 catch-up. IRA $7,000, $8,000 catch-up. HSA $4,150 individual/SEP $8,300 family if eligible, up to $35,000 plus sheltered yearly. Sarah contributes only 8%, approximately $416 per month, inconsistently, at 7% over 27 years, approximately $420,000 from contributions. Marcus auto-sets 18%, approximately $900 per month, to approximately $900,000. Difference, $480,000 just from maxing shelter. Why first? Transfer will boost asset prices and economy. Tax-sheltered money compounds faster without annual drag, 15 to 37% saved over time. Immediate action, log into payroll/HR today. Raise 401k by 1 to 2%. Increase IRA auto transfer from checking. Max HSA if eligible. Grab full employer match, free money. Increase 1% per raise until near limits. Track sheltered total monthly. Aim 15 to 20% sheltered income. This positions you to capture more of the transfer than most regular people. Rule 2. Own broad market index funds. Get exposure to the entire economy so you capture growth from the $124 trillion transfer without trying to pick winners. Don't chase hot sectors, individual stocks, or the next big thing. The transfer will flow into real estate, stocks, businesses, and more. Broad index funds, like S&P 500 or total market ETFs, automatically participate in aggregate growth. Sarah invests sporadically in individual stocks or trendy funds. She misses big moves and pays high fees/taxes. Marcus sticks to low-cost broad index funds, expense ratio less than 0.05%. His money rides the market's long-term upward trend. From 2009 to 2026, the S&P 500 rose 900% plus. Regular people who stayed in broad funds through fear became millionaires. Math? $500 per month into a broad index fund at 7% average return over 20 years yields approximately $250,000 from contributions alone. Miss it by chasing or sitting out to average retirement. Immediate action, open or log into a brokerage, Vanguard, Fidelity, Schwab. Set up automatic monthly investment into a low-cost broad index fund, for example, VTI, VOO, or Total Market ETF. Start with whatever you can, even $100 per month. Increase by 1% of income per raise. Keep it simple, 1 or 2 funds max. Rebalance once a year if needed. This rule ensures you're in the game when trillions move. No genius required, just participation. Rule 3. Build a cash buffer for opportunistic deployment. Have ready capital so you can buy during market dislocations caused by the $124 trillion transfer. The transfer will create periodic moments of fear or forced selling, family disputes, health crises, tax bills. Assets will temporarily drop in price. Regular people with cash on hand buy low and win big, just like those who invested after 2009 crashes. Sarah has almost no buffer. Emergencies force her to sell investments at bad times or use debt. Marcus keeps 6 to 12 months of expenses in high-yield savings, currently 4 to 5% APY. When opportunities appear, he deploys cash confidently. Math example: $10,000 cash buffer invested during a 20% dip at 7% return. Over 20 years, yields approximately $38,700. No buffer, miss the dip, stay average. Immediate action, calculate your 6-month survival number, monthly essentials times 6. Build it in a high-yield savings account, online banks like Ally or Capital One. Start with $100 to $200 per month auto transfer until full. Keep it separate from checking. Treat it as opportunity money, not emergency only. Replenish after any deployment. This rule turns fear into advantage during the transfer's ups and downs. Rule 4. Automate consistent investing and increase with every raise. Make participation in the $124 trillion transfer automatic and escalating. Sarah saves sporadically when she remembers. Growth is slow and inconsistent. Marcus auto-invests a fixed percentage on payday and raises it 1% with every salary increase. Math example: $500 per month, automated at 7% return over 20 years, yields approximately $250,000 from contributions alone. If Marcus starts at 10% and raises to 15% over time, the compounding effect adds hundreds of thousands more. Regular people who automated after 2009 captured the bull run without willpower. Why this rule? The transfer will unfold over decades. Consistent exposure beats trying to time it. Automating removes emotion. Increasing with raises captures more as income grows. Immediate action. Set up auto investments today. Payroll deduction to 401k/IRA or bank transfer to brokerage. Start with 10 to 15% of take home. On your next raise, even $200 per month, increase the auto amount by 1% of income. Log in monthly to confirm it's running. Treat raises as wealth acceleration days. Never let lifestyle eat them first. This rule turns regular income into millionaire-level compounding during the transfer window. Rule 5. Run a 30-minute monthly reset. Review and adjust your positioning so you stay aligned with the $124 trillion transfer over the long term. Marcus does this every first. Opens accounts, writes 3 numbers: total cash buffer, invested balance plus monthly change, sheltered contributions percent of income. He spots drifts like fixed costs creeping, auto-invest not increased, and fixes immediately. Cancels unused app, raises contribution 1%, or moves cash to opportunity fund. Sarah avoids looking. Small leaks grow, positioning weakens. Math impact: catching a $100 per month drift early, unused subscription, or missed raise increase saves approximately $100,000 in lost compounding over 20 years at 7%. Regular resets prevent silent erosion during the 20 to 25-year transfer window. Immediate action. Set recurring calendar reminder for the first or payday. Block 30 minutes, open accounts. Write: 1. Cash buffer level. 2. Invested total plus change. 3. Sheltered percent of income. Ask: did contributions increase with last raise? Any creep? Adjust one thing. Bump auto invest $25. Replenish buffer. Cancel leak. Log it in a simple note. After 2 to 3 months, patterns emerge clearly, like spending spikes after stress. Fix them early. This habit keeps you positioned. No autopilot drift, steady capture of the transfer's upside. Follow these 5 rules for the next 12 months, and positioning to capture a real share of the $124 trillion wealth transfer, while most miss it, becomes extremely difficult to avoid. You won't become a millionaire tomorrow, but the direction shifts. Tax-sheltered accounts fill faster. Broad funds ride every wave. Cash lets you buy dips. Automation escalates with raises. Resets keep you aligned. Picture 2045. Your accounts compounded through decades. No stress over basics. Options: family help, travel, work on your terms. That's not for the ultra-rich. It's built by regular people who positioned early, like those who invested after 2009. Sarah can still get there. You can too. Start tonight with one payroll tweak. This isn't genius timing. It's simple rules that let compounding work during a generational shift. Most will watch from sidelines. You won't. You have the structure now. Start with Rule 1. Check sheltered contributions and raise 1 point. One rule builds it all. You're regular? Good. That's who wins big when trillions move. Position yourself before it closes. Like, subscribe,